Right. Work, 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 work. There we go. We got it. All right. Good morning, everyone. Hope you guys are ready to party today. Big sell-off in the U.S. markets last night. Obviously, we had the S&P 500 took an absolute beating. Not as bad as the Nasdaq. Russell 2000 giving us a 10% correction off of the top. So we've really seen the Russell be the absolute leader after it made that death cross. It's just kind of shown the way and for global equity markets ever since. We have, I think the general sell-off right now is being led not by any particular data, not by any particular earnings announcements, and that actually makes it more worrying than anything. It's happening just because I think the market needs to correct, and so that the fact that there's no real leadership to it means that you don't really know what's going to make it stop, and I think it makes it more of a nerve-wracking sell-off, if you get what I'm saying. If we go into the Asian markets overnight, we had Hang Seng in China that closed for a second day because of the 2-day holiday that they have there. I think it's their independence or something like that. Anyway, you can see the rest of the markets down. Nikkei getting absolutely torched on the back of a stronger yen on the session. We actually had all currencies the last day and a half that have shown a little bit of strength over the last two sessions, or last session and a half. And I think that's something really interesting. We do continue to see, Australia just kind of been drifting down, but those drifts are starting to add up. Those little 0.75% down moves eventually really starting to add up. You can see miners under pressure again. Exporters under pressure out of Australia today, out of Asia today, kind of changing tact after finally gaining on the currencies there. But I think that this is going to be interesting to see how that affects the market today. We've seen dozens of days in a row where we've seen dollar strength, we've seen lower commodity prices, we've seen mining stocks come lower, and everything else that kind of goes along with it. And then now we've seen a slight reversal of that. So it'll be interesting to see how the mining stocks in particular react today, to see if they have any sort of a bounce with that sort of change in trend. Obviously we're not looking for anything too material, but interesting to see how well that correlation continues to hold up. I think we'll get an idea of that today. All right. Excuse me. If we go into here, we've got a great chart here from Bank of Business Insider showing the divergence between high yield bonds and S&P 500, and you can see the high yield bonds have been an absolute leading indicator, to say the least, of where the market's going to go. If you look there, it's kind of leading the market around on a little bit of a leash. And the way that we've seen high yield debt start to turn around quite a while ago, only about a month ago. But as we saw it start to turn around, that really started to mark the peak in the S&P, and you can really see it turning hard. You can see the kind of collapse in demand for high yield debt as of late, and I think that is a big part of what we're seeing right now, and a big divergence to what's happening right now in the equity market. So I think the equity market still probably has a little bit more catch-up to play. And I think what's really important to note is that the S&P's only pulled off about 4% from the highs. And when you think about it in terms of that, and the S&P's kind of on its third longest period ever without a 10% correction, going on 2.5 years or so at the moment, that's also quite worrying. If we look here, this is the chart of the Russell showing. That's right up there where we made the high. It was, I believe, on the second little hump here that happened in September at about 1180. That's where we made the death cross. That was only probably 2 weeks ago, and that's when the short-term moving averages drop below that of the longer-term moving average, and from there we've really just seen an implosion in the Russell, which is really a great leading indicator for what's going to happen in U.S. markets. All right, so no real corporate action to report on the day. Market data out today. We had Japanese monetary basis, which is a bit soft this morning. We've got market construction PMI out of the UK later. We've got PPI out of the Eurozone. We've got local consumer confidence at 12. We've got the ECB main refinancing rates and deposit facilities, which are at 145 today, and that's really, I think, going to be the entire focus of the market today. Is going to be the ECB. Going to see what kind of cannons they're able to come out with. Market's nervous over this. They don't come with something spectacular. I think that Europe gets absolutely decimated on the back of it, so just keep that in mind. We also have initial jobless claims a little bit later in the States, and Bloomberg Consumer Comfort and factory orders, but the ECB today is absolutely everything, so there's very little that you're going to want to pay attention to today outside of that. You can shake off the initial jobless claims today. You can shake off everything else. It's all about the ECB. Obviously, we've got non-farm payrolls tomorrow, but I still think that pales in comparison to what we're going to wait to see from the ECB today. So just make sure that you're not too heavily involved going into that announcement, because there could be some real rips around that time period today. All right, let's get into the maps. All right, first thing that we're going to have a look at is the S&P 500. We are going to look at that. We're going to go all the way back to a 5-year chart here. And the reason why I wanted to show that is simply so that we catch this sort of 2+ years of uptrend that we've really been in. It's just incredibly consistent if you look at it there. And I think if we really tighten this on the line, it's hard for you to see because it's only that one little closing wick there from Friday. Let's zoom it in a little bit further so you can get a better look. And you can really see there, I'll even try to take it in a little bit further now. You get what we're doing with the trend. You can see that we've actually dropped support on trend on the what's a hell of a long-term trend, and that's definitely worrying. I mean, we haven't seen us drop out of that support channel since the last time that we had a 10% correction. We're going to need to see it push down a little bit lower. Obviously, if we saw a bounce today of any material nature, it would end up looking like a great hold, but it's worrying. Below 1950, the market's definitely worrying. You know, we are quite a bit, so we are 4 points below that. If we push a little bit lower, then I think it's kind of confirmed we'll probably end up dropping 1900, I would assume, or, you know, at least down to 1900, if not dropping 1900 to potentially give us this big correction that we've all been waiting for, and now it seems like no one's positioned for. So market tends to do that to us, and it seems like it's done that again. All right, let's look at SA Breweries here again. Obviously, one of the big defensives on our index yesterday got absolutely decimated in the second half of the session, as did most of the other stocks on the index. Down here around 613, 614, somewhere in there, maybe even all the way down to 612. You can see there that's a total gap fill to where we broke down from, or sorry, from where we popped up from. And I mean, I think you can still look at it in this sort of manner here, and possibly say that we're still holding support all the way down to 608. But after that, it maybe gets a little bit fuzzy. I do think that this is probably a decent play when the market calms down a little bit. But right now, obviously, the market feels exceptionally nervous, so we got to play it with a little bit of caution. But just know that we're at some support there. We're at that gap fill on when we saw that huge breakout on the buyout rumors. On Naspers here. We've shown this chart a lot around this 1250 level, and I just wanted to go back to it so that we don't forget to kind of point it out as and when, if it does happen. And you can see there we dropped it on Wednesday. We dropped it on Tuesday on the close, but only moderately, by about $4 or $5. And it spent pretty much the whole day above it on Wednesday. Then yesterday we spent the whole day above it as well, but it absolutely puked into the close along with the rest of the index and closed at 1235, which I think is real confirmation now that we've dropped 1250. There's a little bit of an ugly head and shoulder here going on maybe in this pattern. And so it's a little bit worrying that it's dropped 1250. I think if we hold below that level today, which I would fully expect that we would, then I think we've actually got a significantly lower target now all of a sudden in Nespers out of nowhere. After trading at 1450, a few sessions ago, we've had about, I say a few sessions ago, a couple months ago, we've had about almost a 20% correction from the highs, but it still looks like there might be a little bit more to come on the downside in Nespers. All right. Standard Bank. I'll back this out a little bit more so we can just get a little bit bigger picture here. But we talked about we were looking for Standard Bank when we dropped support up here to come down and test 130. Well, we've got that test as of yesterday. We actually dropped below it on an intraday basis, only to close back above it. This is going to be, I think, a real fight here. I also think if we look at this, I didn't look at this before, but let's just have a bit of a look from this move to the upside here. Yeah, so if we're looking at it in terms of a fib retracements, we're hitting right at a 50% fib retracement, which means we're starting to get sort of toward that level. Maybe a little bit more to come. Technically, we are on some major support here, obviously, but there could be a touch left to come out of Standard Bank. But I think that somewhere around here is probably a decent little level to nibble if you're looking to buy into some support. I wanted to show this one as well, and we hadn't shown it in a few sessions, and we were all over this one when we dropped that little support level there, and this is CFR. You can see when we dropped out of this little widening channel here, and we dropped down, and then we kind of created this little bear flag which lasted for a long time. It lasted for about a month and a half. I'll zoom it forward here a little bit for us. Once we dropped out of that bear flag and we gapped down below 100, we were saying this is all she wrote, and we've got $10 of downside below 100. Well, we pretty much have filled that target now in CFR. So I think our target was 90, 91, somewhere in that sort of level, and we've gotten to that level obviously now. So I think that maybe the short-term downward spike in CFR may be getting closer to an end. Right, and then the last one we're going to show this morning is Vodacom. Vodacom actually showing some real outperformance yesterday. We had this what looked like it was going to be a great head and shoulder setup here, and it just has totally defied what the market's done over the last few sessions, which reversed to the upside. And you can see there it's popped up above the shoulder line. If it rolled over from today, it would still look a little bit head and shoulders, simply because it hasn't really taken out the wicks. But I think all in all, it's definitely it's been a bullish. It's been bullish when the market's been absolutely decimated over the last few sessions. So I think. I think that head and shoulder pattern, if you were playing it, has now been broken and potentially has some upside from here. And that's it for today, guys. Good luck out there.